everyone, and thanks to the Committee for Responsible Federal Budget for having us today. We'll have a good little chat about what's going on in taxes right now in Congress and what the administration is trying to do. I'm joined by 3 tax experts, and you'll hear from all of them in succession. Then we'll have, I'll ask some questions, and then we'll also have some questions that you're able to submit. If you can use the Q&A feature in Zoom here, I will look at those questions and pick the best ones and ask them toward the end. So keep those, start sending those in and I'll take a look. We're going to start with Chye-Ching Huang, who is the Executive Director of the New York University Tax Law Center. And she'll, we'll talk and kind of outline what's happening and what the administration and Democrats are trying to do here.
So, look, I think the overall shape of this package is a pretty straightforward one. It's looking at making investments in a number of areas that are intended to help directly boost families and workers' incomes, while also providing a path towards long-term growth in a way that's sustainable and inclusive. And that investment part of the package is really important when thinking about the sort of net benefit or net costs of the package. But sort of just from a tax policy perspective, I think one of the things that's really interesting to me is not only that the proposals that are on the table for financing this package are progressive ones that raise significant revenue, but they also have attractive factors from a tax system integrity perspective as tax policy. So what do I kind of mean by that? Well, if you look at the tax code that we have at the moment, there are very large, substantial tax breaks and incentives for specific types of income across the code. So capital gains income from the growth in the value of assets is taxed at a much lower tax rate than income from work, or even at a 0% rate for gains that are held until death. The public subsidizes effectively the foreign profits of multinationals by about 60 billion per year, the Joint Committee on Taxation estimates, with a lower tax rate for those profits than the 21% rate on domestic profits. There's a deduction for income earned through pass-throughs that takes the rate on those pass-throughs below the top rates on wages and salaries. And those are just some of the big things. There's a lot more that's scattered throughout the code, and they're things that most tax economists consider to be so-called tax expenditures. They're really features that are spending through the tax code. They're not revenue-raising provisions, but they're subsidies for certain types of activity that could be delivered as spending programs. And there aren't right tax cuts, of course, and we can debate the economic justifications for them, but I think the evidence is not strong that these provisions really encourage a lot of investment or productivity growth. But the two other sort of costs that get missed and that this package proposes addressing in a number of ways is that these provisions create distortions and incentives for investment to flow where it's searching for tax savings rather than the most productive underlying investment. And it also invites well-resourced filers to really sort of push the boundaries of the law in order to maximize those tax breaks. And what we see there is that those well-resourced filers currently can sometimes overstep that boundary in search of those tax breaks. And there's an estimate that about 7 trillion of taxes owed over the next decade will not be paid. A lot of that coming from the very top of the income distribution and high profit corporations that have the access and ability to be able to try to use those tax breaks in sometimes ways that are too opaque for the IRS to see. So we can talk about the specific proposals as we get to Q&A, but the thing that I'm really interested in is that this package of proposals addresses both the underlying tax breaks that create those incentives for investments to sort of flow towards tax shelters and maybe even into tax non-compliance, and also couples that with investments in the IRS, improving information reporting and other measures that would improve tax compliance. And I think together those things would deliver some tax system integrity improvements that are not only good for the budget, but also good for really sort of having confidence in the tax system as a whole.
Great, thank you. Next up is Alex Brill from the American Enterprise Institute. Alex, just give me your sort of overview of what you're seeing in the tax pieces, both the tax cuts and the tax increases that are being proposed here by Democrats.
Sure. Thanks, Richard, and thanks to the committee for putting together this afternoon's event. Those were great remarks. I'm happy to follow on to. I think that the framing is really important here as well. I agree. I want to talk a little bit, in a similar sense, talk a little bit about motivation behind the tax side. First, I think the point that Chye-Ching mentioned about economic growth being part of the overall reconciliation package, distinct from the tax package, is an important one. But I'm going to focus in on the taxes for just a moment here. And a quick trip down history lane. So if we remember, it was only a few years ago that we had another big tax bill, the Tax Cuts and Jobs Act. And when we think about what the motivations were behind that bill, and just sort of compare and contrast motivations here for a second, that bill talked a lot about, as they put that bill together, talked a lot about tax simplification, and that's like higher standard deduction. They talked a lot about lower statutory tax rates. They talked a lot about the competitiveness of businesses and lower statutory tax rates on business income. They talked a lot about economic growth contained in the tax provisions. And now different folks are in charge, and we can head in a different direction if the Congress chooses, and we're facing another tax bill that's headed, I think, in a different direction. And the first thing I would just note, to be Captain Obvious for a second, is the agenda here is not a quote unquote repeal and replace, right? Repeal and replace is Republicans' answers to Democrats' healthcare policy. Democrats have the opportunity to repeal and replace the Tax Cuts and Jobs Act, and that's not what this bill is. There are provisions of the Tax Cuts and Jobs Act that are either being proposed to be repealed or unwound or partially repealed, some to be extended and some to be expanded. So it's taking the tax code not back to the pre-TCJA way, which I think is just an interesting fact. It suggests to me that many provisions of that bill actually have some bipartisan support, although that whole package, of course, was also a very partisan uniparty effort. What I see as a motivation, before we get to the specific policies, is a desire to increase the progressivity of the tax code. I think it's motivated a little bit by what I consider to be a false belief that the tax code is not very progressive. I believe it is quite progressive already, but it's an effort to increase progressivity through two broad approaches. One, reducing taxes for low and moderate income households, and we have things like the expanded child tax credit, the EITC provision, and to increase taxes on high-income individuals. I also think, and I may be totally wrong on this because I have a strong bias because I'm a tax guy, but I totally believe that objective, the increasing progressivity of the tax code, is the horse that's pulling this overall cart. It's the thing that I hear most about. And again, maybe it's selection bias on me, and because I'm not an expert in community college and pre-K education. But I think that objective is the primary objective behind the whole reconciliation bill. And then the tools to get there are the levers of increasing taxes on capital gains, corporate income, a new tax bracket on millionaires, higher marginal tax brackets for high-income individuals. And that objective may create more neutrality, but also raises the overall effective tax rate on investment. And that's a concern to me.
Great. And then third is Marc Goldwein from the Center for Responsible Federal Budget. And Marc, you sort of comes at this from not just the tax, but a broader fiscal perspective. What are you seeing in here, and what is not just the tax package, but the overall package kind of looking like?
Yeah, I'm glad to be here. I first should say we don't know what the final reconciliation bill will look like. What we do have is a House proposal and the scored part of it we basically have is the tax provision. And based on that, there's about $2.3 trillion of revenue increasing provisions and about $1.3 trillion of revenue reducing and refundable credit provisions. So it's basically almost $2.5 trillion of tax increases and $1.5 trillion of tax cuts and other kinds of credits. If you think about what you want to accomplish at tax policy, especially in this context, I think you want a few things. You want to raise enough revenue to cover your spending. You want to meet your distributional goals, which, as Alex mentioned, in this case is increased progressivity. You want to make sure we're collecting the taxes we owe. You want to make the tax code more efficient and fair, including by cutting loopholes and certain tax expenditures. And you probably want to tax bad things and not as opposed to taxing good things. On each of these factors, I think the House version of the bill is maybe 3 steps forward, 1 step back, and 1 step still unknown. It absolutely recognizes the need to cover new spending with new revenue. We can't afford to have, we can afford a 21% rate and a 37% rate for a corporate individual, but not if we're going to have a much larger government or even the size government we have. It is a lot of revenue raising provisions. They are mostly quite progressive in nature. But again, with that 1 step back, there are also provisions that are less regressive, that are upper middle class tax benefits that create essentially new bond subsidies for the very wealthy. And while it's not in there yet, if they do SALT cap repeal, that would be potentially a huge windfall for the wealthy and a big revenue loss that would eat up a lot of these gains. Similarly, on collecting taxes we owed, this funds the IRS an additional $80 billion over a decade. CBO thinks that's enough to generate 200 billion plus of revenue because the IRS can actually collect the revenue we already owe. The infrastructure bill has an additional measures related to cryptocurrency. There's some other stuff in here. On making the tax code more efficient, this is a mixed bag. We certainly find some loopholes. The House certainly found some loopholes and closes them. Right now, some people pay a Medicare tax, some people pay an investment tax, and some people pay none. It closes that loophole. It shrinks the 20% deduction for business income, but it also actually reverses some of the tax breaks that were cut during the Tax Cuts and Jobs Act, and it creates new tax credits and restores some of the old ones. And in terms of taxing, good, not bad. There's a tax on cigarettes and Superfund. I can tell Richard's giving me that my time's up, but I'll just say 3 of the unknowns that I think would make this bill a lot better and are in discussion, but not in the bill. One would be there's a lot more we can do for better information reporting, including from banks, so people pay the taxes they already owe. 2 would be look at taxing carbon, right? If this is a climate bill, we can do push and pull at the same time. And number 3, stepped up basis is probably the worst loophole in the code. There's a lot of discussion about doing something to address that, so people pay capital gains taxes at some point, but it's not in the House version as of now.
Great. Well, I guess I want to come back to Chye-Ching, see if she could respond to what Alex said about the code not, being more progressive than is sort of commonly thought, or that, that there he sort of made the suggestion there really isn't a significant progressivity problem to be solved. So I was curious if you have some thoughts on that and on what this bill does and at least in the current version doesn't do to try and address some of that.
Yeah, gotcha. That's a great question. And look, I'm not sure about the motivation of the progressivity being the driver here. I tend to I can't speak for what the lawmakers are thinking about, but if I were approaching this, I would be looking to raise sufficient revenues to fund the government and the investments that we would want to have, thinking about what delivers good long-term benefits. And if I were looking to finance that, my first port of call would be progressive revenues because of some of these large tax expenditures that are very tilted towards the top. And also because of the fact of how the economy has worked over the last few decades, in which low and moderate income households have really not seen the same types of living standard gains as those at the very top. So that would be my frame and rationale for looking for progressive revenues. I also think there's been some really interesting work done around, in relation to Marc's mention of the step-up basis loophole. It's actually interesting that a lot of the income that currently goes to very high wealth and high income filers is currently most often invisible when we try to think about how progressive or not the tax code actually is, because that income doesn't show up on tax returns, and therefore, because of data availability reasons, doesn't show up on the tables where we try to look at how much people at different income levels pay as a share of their income and tax. So those unrealized capital gains, which are a big source of the income of the very highest income and wealth people, is not counted when we're trying to calculate their effective tax rates. So there have been a lot of data and methodology questions about how exactly you should do that. But directionally, the case is pretty clear that if you were to count that income, some of the effective rates of the very highest income people are actually a lot lower than we tend to think.
Alex, I'm curious if you could, do you want to respond to that, but then also trying to address the sort of economic question of, you talked about the various tax increases on pass-through companies, on high-income individuals, on corporations. How concerned are you about those changes affecting the level of economic activity and economic growth? Or is there sort of, not free money, but is there sort of revenue to be gained from those groups without really damaging the economy very much?
Yeah, it's a great question. So first, I don't want to, I want to be clear not to oversell the economics of any of these policies, the ones that are on the table, the ones from 2017, the ones from 2001. So I'm a big believer that the tax policy matters and it affects investment decisions, not just the allocation of investments and therefore, creating distortions, good or bad, but also the overall level. But I don't want to suggest that, the right tax policy makes 5% GDP and the wrong tax policy makes negative 5% GDP. These are on the margin and these are small effects, but they're important and they compound over time, and we should have the ones that are most efficient. But I don't want to seem to be exaggerating this point at all. A couple of good things that were just said by both of the other speakers. They just want to respond to quickly. First of all, my biggest complaint about the stepped up basis loophole is only the word loophole, because a loophole, it's a technical, it's like technically it gets under my skin. A loophole is like something that like wasn't intended, that like was it like a drafting error. This is not a drafting error at all. And we've accepted this policy for a long time. That doesn't mean that it's the right policy, but I don't think it's a loophole. I think it's just a question about whether we want to have stepped up basis. I think that it does create a distortion. It creates a strong incentive to hold assets to death and provides a tax benefit to those individuals. I'm agreeing with my colleagues on that point. I also want to touch on this question that both Marc and Chye-Ching mentioned about the tax enforcement issue, and just double down on that. I think that policy is the right objectives. It's a good objective here, and I think that there's reason for it to be appealing to Democrats and to Republicans. And I think for Republicans motivated by rule of law principles, I think that adequately funding the IRS and giving them the information that they need to do their job, it should be a no-brainer. I think we need to be very careful when we get into the weeds and we think about exactly how we implement that and what the compliance costs are and who's paying those compliance costs. We got to sort of sort through the technicalities there, but the objective there, I think, should be appealing to Republicans. And for Democrats, it should be appealing for those reasons, and it also may be appealing to them because it goes to this progressive issue, because a lot of those unpaid taxes are taxes by high-income individuals. And then the other thing that just came up that I want to mention, Marc's point about taxing carbon, I think is exactly the right way to go. This is a climate bill, and there's a lot of climate policy in here, and there's a lot of tax breaks in here for clean and renewable energy. And I think that it's going about it in the absolutely wrong way. But I think that objective of how can we address climate change and use the tax code, I think is a great idea, and it's a tax code is an appropriate tool. I wish they did it the opposite way than it's being pursued right now. Maybe that's in the cards.
Well, I think one of the reasons we haven't seen that is that the administration has declared that policy to be at odds with the president's "I'm not going to raise taxes on anyone below 400,000" pledge. And so I was curious if Alex or if Marc wants to come in and talk about that promise, how it's being interpreted, particularly with respect to corporate taxes and tobacco taxes that clearly have some effects below 400,000, and what that promise has done to sort of shape the bill that we've got in front of us right now.
Yeah, look, I used to say the worst pledge in tax policy is the no taxes below 250,000, but we've one up that with the under 400,000. The no new tax pledge at all, of course, is worse from a fiscal policy perspective, but it's a on net pledge. It's not any provision. And the idea that no provision can raise taxes for folks making less than $400,000 is a big impediment to good tax policy, let alone good revenue raising policy. It's an impediment to the extent you want to extend it to excise taxes or corporate taxes, whatever, but it's also an impediment with the income tax. It means you look at some of the reforms in this House bill, and there's one set of rules for people making under 250, a second set of rules for people making between 250 and 400, and a third set of rules for people making under 400. There are really egregious loopholes. And by the way, Alex, I a little bit disagree with you on the stepped up. But there's very egregious loopholes in the tax code that we can't close because it would affect someone making below 400,000. That makes no sense. And what I'd really like to see is them switch this to the net effect of our tax cuts. The net effect of our taxes is no increase below 400,000, rather than trying to nitpick every single policy.
Should actually be the average net effect, right? Because otherwise you can find one special case and then
Yes, the
therefore
average
you're
net effect. That's right.
Let's, before we go to the audience questions, and I've got 14 already, so we've got plenty to 15. So we got 16. So we got plenty to go through. I was curious if you, Chye-Ching in particular, could talk about or anyone wants to talk about the IRS enforcement provisions. I think the piece about spend 80 billion more over a decade, that'll roughly double the size of the IRS staff. That will lead to more audits, more revenue. That's sort of pretty straightforward. But the other piece, the one that isn't in the House bill, the one that's getting a lot of pushback from banks and Republicans, is this idea of sort of adding two boxes to the 1099 INT, where for most bank accounts, the banks would have to report gross inflows and gross outflows. Like, what do you each sort of think of that idea? Is that workable? Will that meaningfully reduce, immediately increase tax compliance without sort of being the invasion of privacy that people talk about, or is it a real concern?
Perfect question. And I love how you posed the question by actually describing the policy, because I think a lot of what we hear about the policy actually kind of misdescribes what it does. So it is important to sort of understand what it is in terms of information for that privacy question, what the IRS would get. But to sort of step back a little bit, I think the information reporting piece is a really critical part of the compliance regime. It's really important that as you add back some of the 30% of audit staff that have been lost over the last decade because of budget cuts to the IRS, that the audits are targeted towards people who are most likely non-compliant. And that's what the information reporting allows you to do. So it is actually a thing that benefits accurate filers, because it makes them less likely to be subject to an audit unnecessarily. So I think it's a really critical part that goes along with the investments in technology, being able to answer the phones and all of those good pieces as well. In terms of the proposal itself, yeah, I think the privacy concern has been, I mean, I've read some statements from some of the lobbies that are trying to push back against this, and they portray it incorrectly as the IRS having access to transaction data, which is absolutely not the case. It's total inflows and outflows, and it's the banks that will have to give that information to the IRS, just like with the 1099 INT. So it's not additional compliance costs on individuals. It's not transaction level data. What it really does is allows the IRS to see on aggregate, is this person got a lot of potentially unreported income flowing in and out of their financial accounts that they're not reporting to the tax authority. And that is a big problem for non-compliance at the moment. There's a lot of unreported business income.
Yeah, I mean, just to add a couple of points. Remember, we already report people's wage income as is. The government already knows exactly how much wages you're getting. This isn't saying we're going to try to track all your income everywhere. This is giving them a little bit of extra data so that the IRS can actually be less invasive, right? They can target audits more precisely to people that are most likely to have underpaid their taxes, rather than having to paint a broader blanket. I'll also say, just to Alex's previous point, on this should get Republican support, at least in concept. Every single president, from Ronald Reagan through Donald Trump, as proposed in their budget, tax compliance, tax gap measures, including more funding the IRS, including information reporting changes, and including other ways to expand our authorities and ability to collect taxes owed.
All right, let's dive into some audience questions. There are a few on the state and local tax deduction, which a couple of you referenced. This seems likely to be, just for political reasons, likely to be included some increase or repeal. And you don't all need to answer each of these questions, but if someone can sort of talk about who benefits from that, and what sort of merits are of of adding, what we're hearing is maybe like a 2-year temporary repeal or something like that of the cap.
I think I'm not sure where Alex is on this, but I associate myself generally with Marc's comments on repeal of the SALT cap, or temporary lifting of it, or anything else of that nature. I don't think it would be a good use of valuable resources. I do want to try to do my best to acknowledge the sort of the core of the argument on the other side for lifting the cap, which is reasonable, but also not really borne out by the evidence. And the argument is that the distribution tables show that this is a really regressive benefit that flows to people and that have a lot of deduction and a lot of income and a lot of tax expense, and that therefore it's not a particularly good way to spend fiscal dollars. The response from the folks that want to see this capped or rolled back is that it is an incentive or a support for states to raise progressive revenues and spend those revenues on investments that have broadly shared benefits in states. And I think that's a completely reasonable question to ask and to think about whether or not the SALT deduction and the cap has those impacts. Especially because when lawmakers in the 2017 tax law were enacting it, some of them very explicitly said that they wanted to have this cap in place in order to take away that support for states. However, the sort of empirical literature is pretty tenuous that this is a real impact that happens. And in the years since the 2017 tax law, we have seen states actually increase their taxes on high income people and move forward with investments in a way that is progressive. So for those reasons, I tend to sort of put a little less stock in that question than when, even just a couple of years ago when we didn't see how states were reacting to it.
Alex, we've got a couple of questions from people who ask, one is about whether an increase in tax on businesses gets passed along to consumers who are making less than 400,000. And sort of more broadly, who pays corporate taxes? Can you sort of answer that question about what happens to consumers and workers and shareholders when business taxes go up?
Sure. I think it's an important question in this debate that we're having, and it was an important question in the tax debate a few years ago as well, which is who bears the burden of the corporate income tax. And it's an open question to some degree. What I mean by that is we don't know with high precision the precise distribution and distributional impact of the corporate income tax. But what we do know I think with high confidence is that a portion of the corporate income tax is borne by workers and sometimes is passed through in prices as well. But the debate is mostly about whether that burden falls on workers and wages or on capital income. And there's a debate about the extent to which it falls on wages, but there's very little debate. There's very little argument. There's basically no academic argument that suggested it doesn't fall to some extent. And so there's some evidence that a very large portion of it, 50% or more, might fall on wages. The view of the Joint Tax Committee and the Treasury Department is that it's, if I recall correctly, 20% of the burden falls on wages. And so what that means is when we raise those statutory rates, we are over time impacting wage growth in an adverse way. And that dynamic, that precise number, as we have more research, we will refine that estimate, and it may change depending on how open or closed the economy is and how global we are in our business activities and things like that. But what we do know is that some portion, not insignificant portion of the corporate tax is is impacted in the sense of wages.
I mean, just to add that a little bit, even if none of this were borne by workers, shareholders are not exclusively people making over $400,000 a year. People have retirement accounts and pensions, et cetera. So corporate tax increase is going to affect people. Guess what? People pay taxes. That's the reality. But the problem is the pledge in the first place. The idea that no tax burden can increase on anyone below 400,000 is just silly. And so I think trying to have as narrow an interpretation of the pledge will make for much better tax policy.
Yeah. I also think that it's important that even in these sort of estimates of the flow through to labor, the sort of intuition that sits behind that flowing through assumes that you don't just sort of ratchet up public debt by the same amount, because that would have an offsetting impact on national investment and productivity and all of the things that the corporate tax cut is supposed to do. So there is this implicit assumption that there's some budgetary offset that happens in the long run. So again, sort of coming back to where we started, one really has to think about both the tax side and the spending side together to figure out who across the income distribution is going to be better off and worse off over the long run, as well as the overall size of the economy.
I've got a couple questions about step up in basis and the way that it relates to other taxes. So one question that says, well, wait a minute, like, isn't that accounted for in the fact that there was already a corporate tax on this income? And another that sort of talks about the intersection between that capital gains tax of death and the estate tax. So, because, why can't you have a compromise? The participant asked, provide the person with the ability to either get step up in basis or the estate tax exemption, but not both. So Marc or whoever wants to kind of talk about that, the interaction between step up in basis and the corporate tax, and between that and the estate tax. Because I think there's, right, it's obviously, I don't use the L word, because I tend to agree with the way that Alex thinks about the word loophole, but it's clearly a gap in the income tax. There's gain in wealth that is not being taxed by the income tax, but you also got the corporate tax and the estate tax out there. So Marc, you want to start, and then anyone else wants to jump in on how those taxes all sort of relate to each other.
Sure. So there is this question about double taxation between the corporate tax and the capital gains tax. And the truth is, some income is effectively double taxed, some is taxed once, and some isn't taxed at all. But because the corporate rate and the capital gains rate are so low relative to the individual rate, even the stuff that's double taxed isn't really taxed, a particularly large differential from ordinary income. Closing the step-up base, eliminating step-up basis, or closing the loophole. The loophole is the fact, by the way, that people take advantage of this provision that's explicit to never sell their capital gains during their life. That's the loophole part. Whereas the fact that you don't pay it at death is the provision. But this really doesn't have to do with that, right? Like, there's two questions. One question is, what should the appropriate capital gains rate be? And maybe you'll say 1%, and maybe you'll say 39%. And the second question is, how should we apply it evenly, or should we only apply it to some people and not to other people? And right now we're only applying it to some people and not to other people. As for the estate tax, if we really had a robust, taxing stepped-up basis at death, I think in some ways the estate tax would be a double tax. And there's other reasons for that. It has a different purpose. It's trying to address dynasty wealth, et cetera. But right now the estate tax applies to like 10 people a year. It's only on very, very, very high levels of income after assuming you don't jump through pretty easy hoops to avoid it. And again, we still have stepped up basis. So kind of in this argument to not double tax, we're taxing a lot of income at 0 times.
Well said.
There's back to the IRS information reporting, a question: how do you sort of expect the IRS will use it? Because there's so much money that flows through bank accounts that's not taxable, loan proceeds, return of capital, gifts. So it seems like a fair amount of waste of time and effort to get explanations about all those non-tax inflows. So how is the IRS likely to use that information, and particularly in the early years of having this information when it doesn't quite know what to do with it? Would we expect sort of more what they call no change audits where they come to you and say, well, we looked and there's nothing there, and will that get better over time?
So if I were the IRS, and I'm guessing that they have people that are even smarter than me thinking about this as well, but so one of the things I would want to do in terms of those sort of lumpy forms of income is to ideally look at people across a number of years and seeing if they're consistently reporting through their bank accounts large amounts of flows that are not explained by their tax returns, and that will sort of take out a lot of the one-time changes. The other thing that the IRS can do with this information to figure out how to best use it going forward is to look at the information on these returns the information on these information returns and how that matches to audits that they would have already done given their current algorithms, and see on those audits whether they're seeing things that explain or tell you that this information is more likely to be useful or less likely to be useful in certain circumstances. So I think there are a lot of ways that one would want to sort of really try to make the best use of this information rather than just doing no change audits. And I do think that it is important that either administratively or in the legislation that there are some oversight requirements and some reporting that happens over time to make sure that that's happening.
I'd just add to that. I mean, I think that there's two issues here a little bit. There's the implementation of this policy, and then there's the principle of the policy. I think we're all in agreement that the principle here is a good one for a number of reasons, to have more information so that we can have better administration of the tax code. It feels like it should be something that's like so not controversial that it's just dumb boring, but it is controversial, of course, and that's why we're talking about it. And there are others who have other views and are concerned about privacy issues and the compliance cost issues. And I think that those questions need to be, sort of worked out, including the timing of these issues. Like, I don't think that the IRS can do a perfect job tomorrow if we pass a law today. I think it takes time. I think they need time to hire workers, time to train workers, time to build algorithms, time to figure out how to process the data. And they need to, I think everyone who's looked at the tax gap has recognized that there's one question, which is how big is the tax gap? And there's another question, which is how much of that tax gap can we whittle away? And those are different numbers, right? And we should not try to have zero tax gap. That would be incredibly burdensome on taxpayers and on the economy and on government. But should we say, oh, we have a pretty reasonable, fair, okay, tolerable tax gap? I think the answer is certainly no. And instead of raising statutory tax rates higher or even higher or more higher, just enforcing the rules that we have on the books and giving the resources to that agency seems like just incredibly appropriate.
One question is, besides changing step up in basis, what is one major tax proposal that you wish was in this bill? So I'll amend that slightly and say, that would is not just your pet thing, but that would sort of fit with the direction of where Democrats would want to go. Or is there one major thing that's in this bill that you wish, could come out? Like, what is your, if you were like Ways and Means Chairman for a day, what would you put in or take out? And I guess for each of you to sort of jump in on that would be great.
Well, right, so we already said step up information reporting, but if they're going to put the SALT cap repeal in, I would take that out. And if they're not going to put that in, then I would add in full SALT repeal, including for business individuals. Even with the $10,000 cap, I think we're giving more SALT deduction that makes sense, and you can raise revenue very progressively to fund your agenda by getting rid of that altogether.
I'll have to go next. So, Mark, I agree with what Mark suggested on SALT, and he tucked in there the business side of that, which I think is also really interesting and worthy of consideration and exploration. But let's go further on that policy. I agree with that. Mark also mentioned taxing carbon. Both of us did, and I think that would be a great way to, and consistent with the green energy, clean energy agenda as something to add to the bill.
Trying not to repeat, I think there are some great sort of partnership tax proposals on the Senate side that would address some areas of complexity and non-compliance as well as raising revenues. 199 Cap A is an area where I'd go further. There are a number of other areas where I think we could go sort of further from a rational tax policy perspective, dealing with grants, dealing with some of the interactions between capital and charity, etc. I think I have trouble trying not to be too greedy about it in the sense that, from a tax policy perspective, you would want all of those interacting pieces to be working well together. But this is not really a broad tax reform bill. This is a bill about mostly the infrastructure proposals and doing kind of just enough to get that over the line. So one has to sort of realize that it's not kind of broad tax reform that's going to sort of take care of every domino that might fall.
Can I just add, just because I'm so
sorry, I said something controversial.
No, I just wanted to say that since I am so broadly negative on the bill overall, I don't want to say that there's not a single provision that I don't like, and I think that there's a provision to make the child independent tax care tax credit permanent. That's about $100 billion in this. It's not an insignificant cost. I think that's a worthy provision that's worth noting and worth keeping.
I was just going to say everything that Alex and Chye-Ching said to add, I would add. And frankly, if we're writing this from a tax policy perspective, they would be in the front of the line well before we started messing with rates and some of the other things that are in the bill, which I also think are fine.
I think Chye-Ching mentioned Section 199 Cap A, which is the 20% deduction for pass-through business income. With a question about whether sort of who's benefiting from that. Is that really going? How much of that is going to small businesses versus larger pass-through businesses? Is there some good data on that, and who really benefits from that provision?
Yeah, I'll correct myself on Twitter if I'm misremembering this fact, but I think it's about half of the deduction goes to the top 1% of filers. And when you think about pass-through businesses, the sort of the data on this is that you really should be thinking about finance firms, real estate, and holding companies. Those are the sort of where the big dollars flow. So I think, you know, this provision is, to me, kind of obnoxious, not just from the distributional perspective, but also because all the way up and down the income scale, it creates this really pernicious incentive to recharacterize your income in order to get into this tax break. And that is just a really big pressure on sort of tax avoidance and evasion.
Yeah, I think this is another one of those that it's a deduction, but it's also a loophole because it allows people to reclassify their income.
Well, good. I think we're just about at our time here. If you guys want to each take 30 seconds or so and add anything that we forgot to get to, and then we will let people get on with the rest of their afternoon. Let's go in reverse order. Marc, you want to go first, and then we'll go to Alex and then Chye-Ching.
Well, look, what we haven't talked about in this is whether the whole thing adds up. And so far it doesn't. We have about $2.9 trillion of tax increases plus health savings to pay for what's supposed to be $3.5 trillion, but it's looking like $4.5 trillion of spending. We either need to bring the spending down, bring the revenue up, or some combination. I hope we do all of it and don't just have stuff cut off after 3 years instead.
I'll make a broad budget point, which is we enter this debate on an unsustainable fiscal path. And so if we think that the revenue raisers are okay or good or great, we already are in need of ways to pay for the spending commitments that we've already made. And we should be cognizant of that. And then the second point that I'll make, I think that Marc is far too liberal with his definition and use of the word loophole.
Chye-Ching.
I'm not going to weigh into the great loophole debate. Look, I think the long-term focus is a really important theme in this package. If you're thinking about investments, you're looking at the long-term returns that they give, and also the long-term impacts on the budget. And you know, a lot of these provisions, I think the child tax credit is one that hasn't been talked about a lot today, have, you know, the research shows some really, really promising you know, prospects of delivering those long-term returns across the life cycle of a child into their sort of adult earnings. So I think some of those things are not going to show up in the official estimates or the scores. That's probably for good reason. They're hard to estimate, but they're part of what we should be thinking about as in addition to the sort of the long-term budgetary situation that this puts us in.
Great. Well, thanks to the three of you, to Chye-Ching Huang, Alex Brill, and Marc Goldwein, and thanks to the Center for Responsible Federal Budget for hosting us, and to the like more than 200 of you who were here. I'm sure, I know I'm happy to answer if there's questions we didn't get to. I'm happy to answer them if you email me. I know the other panelists, I can't speak for them, but maybe they would too. And so thank you, and maybe we'll do this again sometime.